The market for Sofi Technologies Inc., ticker SOFI, is currently closed. The last reported closing price was $25.48 on Friday, November 21, 2025, at 8 p.m. GMT-5 in the after-hours session, which followed a day where the stock showed resilience with strong volume and a late bounce. Now, most investors are focusing intently on the company's push toward consistent profitability, which is the baseline expectation. But the truly captivating insight lies in the sheer scale of the institutional buying that has underpinned the recent multi-month run-up, especially in the last quarter, where we saw the total shares owned by institutions surge by nearly 10%. Firms like J.P. Morgan, for example, dramatically increased their position, indicating a serious belief from big players that the narrative is far from played out, a development that creates an immediate curiosity loop. Why is this smart institutional money making such aggressive moves right now? And what are they seeing that the average investor might be missing? The general belief about Sofi Technologies is straightforward. It is a high-growth, one-stop digital financial services provider, primarily known for student loan refinancing, that successfully secured a national bank charter and is now fighting to prove it can transition from a high-burn fintech to a profitable, fully regulated financial institution. The market has been rewarding its member growth and expanding product offerings, which is the surface-level story. However, the deeper, more nuanced reality is that the stock's performance isn't just about the shift to profitability. It's about the underlying infrastructure business, Galileo, and the strategic, almost impenetrable moat the bank charter provides, especially in the volatile crypto space. The recent news that Sofi is the first and only nationally chartered bank to launch crypto trading for consumers, integrating it seamlessly into their FDIC-insured platform, is a significant, underappreciated development. This move is a direct challenge to unregulated exchanges and a massive confidence play on regulatory clarity, positioning Sofi not just as a consumer bank, but as a critical piece of the future regulated financial plumbing. This action forces us to rethink the valuation models based purely on traditional lending metrics, suggesting the company is building something far more defensible and sticky than a simple challenger bank. Focusing on recent price action, the stock has been volatile, which is characteristic of high-growth fintechs, but the overall trend has been strongly upward, gaining over 65% in the last year. The daily swings often correlate less with macro news and more with internal performance metrics and short-selling dynamics. We saw a notable drop-off recently, likely fueled by some profit-taking after the rapid ascent. And this movement was exacerbated by general market softness in the tech sector. Trading volume has remained robust, hovering well above the 30-day average on both upswings and downswings, a sign of high contention between bulls and bears. The stock's ability to recover from intraday lows, as we saw on Friday, with a rebound from $24.11 to a close near $25.50, is a technical signal that institutional money is stepping in to buy on weakness. This pattern of high volume and quick recoveries suggests that the recent upward price momentum, which has seen the price swing from a 52-week low near $8.60 to highs above $32, has solid fundamental support, contrasting sharply with the narrative that the stock is purely a retail-driven meme play. The core business model of Sofi is its comprehensive financial services ecosystem, a vertically integrated structure that handles everything from lending and wealth management to banking and technological infrastructure. The company's growth is driven by a flywheel effect. Attract a member with a simple product like a student loan refinance, and then cross-sell them on high-margin products like a checking or savings account, credit card, or their investment platform. The key here is Galileo, their technology platform that powers other fintechs and neobanks. Galileo provides a steady, high-margin, fee-based revenue stream that is less sensitive to interest rate fluctuations and credit risk than the lending segment. This fee-based revenue increased significantly in the last quarter, which is a major signal that the company is successfully diversifying its income away from reliance on student loan origination, which has been subject to government moratoriums and general macroeconomic uncertainty. The older reports show a company that was once heavily reliant on student loan refinancing, but the most recent data confirms a profound shift. Deposit growth at Sofi Bank is strong, allowing the company to fund a greater portion of its loan originations with its own lower-cost capital. This is the ultimate goal of the bank charter, to normalize the cost of capital and insulate the business from external funding shocks. Now, we must confront the reality of short-selling pressure on Sofi. This is a crucial element for any modern investor to understand, especially in stocks with high retail interest. Sofi remains a favorite target for short sellers, with the latest reported short interest around 110 million shares, representing approximately 9.31% of the float. While this percentage is not astronomically high for a growth name, it is certainly meaningful and suggests that a substantial number of large, sophisticated investors believe the stock is overvalued. The short thesis centers primarily on two things: valuation, the stock trades at a premium multiple based on current earnings and book value compared to established legacy banks, and the inherent credit risk of a rapidly growing loan book in an uncertain economic environment. They argue that the growth premium is unwarranted until consistent multi-quarter profitability is proven beyond a doubt. The days to cover, which measures how many days it would take short sellers to buy back all the shares they sold short based on average trading volume, stands at approximately 1.52 days. This is relatively low, meaning a short squeeze event, while possible, would require an extraordinary and sustained buying frenzy. However, the off-exchange short volume ratio has been hovering around 32%, a figure that often sparks discussion on retail forums like Reddit and X, where traders call for greater transparency in dark pool trading. This high off-exchange activity suggests significant shorting interest that isn't always reflected in standard exchange data, adding a layer of complexity to the true level of bearish conviction. For the retail investor, the actionable insight is not to chase a short squeeze, but to use this data as a gauge of institutional friction. Rising borrow rates, which indicate that it is becoming more expensive for short sellers to maintain their positions, have been relatively low for Sofi recently, suggesting the pressure is manageable for the bears right now. To monitor this, investors should consistently check FINRA data for fails to deliver and the bi-monthly NASDAQ short interest reports. A spike in days to cover above 3 or 4 days, combined with a sudden jump in the cost to borrow shares, would be the true technical signal that the short thesis is collapsing and a squeeze might be imminent. The primary takeaway for retail is to stick to the fundamental story. The short sellers will be proven wrong only when Sofi delivers consistent, gap-based net income quarter after quarter, proving the durability of their business model. Until then, the friction between high retail conviction and institutional skepticism, evidenced by the high short interest, will continue to drive volatility. What's your take on the rising short interest? Smart money or manipulation? Comment below. Looking ahead, the future outlook for Sofi is fundamentally tied to two key variables: interest rates and student loan policy. If interest rates stabilize or even decline, the lending segment becomes more lucrative as loan demand increases and the cost of servicing their debt moderates. The student loan business is still a major wildcard, and any final clarity from the government on loan forgiveness or refinancing policy will be a significant catalyst, whether positive or negative. A positive catalyst would be the government fully restarting payments without new forgiveness programs, pushing more borrowers toward refinancing options. The risk lies in a prolonged high-rate environment, which hurts loan origination volume and squeezes net interest margins. The opportunity, however, is in the growth of the Galileo and technology platform. If Sofi can successfully expand this business line, signing up more large financial institutions and expanding its global footprint, the investment thesis shifts entirely from a cyclical lender to a high-margin financial infrastructure utility, commanding a much higher, less volatile valuation multiple. This is the true tension between expectation and reality for Sofi. The expectation is that the lending business will carry them to profitability. The compelling reality is that the Galileo platform could be the real engine of durable, high-margin, and highly valued growth. This structural advantage, which few of its pure-play fintech rivals possess, is what keeps